Greetings from 3Edge Asset Management and welcome to another edition of the 3Edge Weekly Update. I'm Fritz, the Chief Investment Strategist here at 3Edge, and pleased to be joined here this week by Eric Biegeleisen, Director of Investment Research here at 3Edge Asset Management. Eric, good to see you.
Thanks, Fritz. It's an absolute delight to be here.
So since we've turned the page on the month of August, as we do each month, Eric and I will be providing our regular monthly View from the Edge update, and that is an overview of our most recent outlook for the global capital markets based upon our 3Edge proprietary research model. So let's get started. Let's talk about the markets. After a stellar month of August, today U.S. equities declined by the most in almost 3 months, with a decline accentuated by investors selling technology stocks, including Apple, Microsoft, Amazon, and Facebook. So, at least for today, for one day, investors seem to be questioning the justification for the high equity market valuations in the midst of a continuing global pandemic. Today's decline, however, comes on the heels of what was a stellar month of August. In fact, August was the best month of investment performance for U.S. equities in 30 years. So, it remains to be seen whether this is a temporary reprieve following a series of record highs for the U.S. equity markets, or the beginning of an equity market correction. Only time will tell. At least up until today, investors seem to be putting their faith in the capacity of the massive monetary policy intervention by the Fed to provide a glide path for the economy to recover from the coronavirus global pandemic. Assistance from the Fed was reinforced in August when Fed Chair Powell spoke at the Jackson Hole Symposium and announced an adjustment in Fed policy when it comes to inflation. Powell announced that the Fed would now aim for an average inflation rate as opposed to an inflation target. So this simply means that the Fed will now allow inflation to run moderately above 2% in order to attain an average of a 2% inflation rate over time. So in the current environment, this change in policy provides more evidence that the Fed will maintain its current historically low near zero interest rate policy for even longer. Investors are also laser focused on any potential news on progress on the development of vaccines for COVID-19, while the US and the rest of the world still struggle to get ahead of the coronavirus with only limited success. Both Democrats and Republicans have also now concluded their conventions. The presidential election is just 2 months away, and polls seem to be tightening in key battleground states. One thing to keep an eye on is the potential for investors to grow concern over the possibility of a contested election where the outcome may not be able to be determined days or even weeks after the election, and that could prove to be a concern for the capital markets. Given strong mid-year consumer demand, possible that GDP in the third quarter is going to come in quite strong. However, investors are more concerned about the fourth quarter and the potential for a sharp slowdown in growth. So with all this going on, very glad that Eric is here with us today to sort all of this out. So Eric, let's discuss the major asset classes that represent our highest level view of our investment universe and what may have changed in our model outlook since early August. And let's begin by taking a look at the equity markets. After a stellar month of performance in August, tough day today, what is our research indicating for equities from here?
Yeah, that's right. Throughout much of the month of August, we saw the 4 major equity asset classes that we model all rise to the top ranked spots with positive risk-adjusted projected returns. Interestingly, on the year though, through the end of July, only U.S. equities had turned positive on the year, while now through the end of August, 3 of these 4 equity indices that we model have turned positive, leaving only Japan with slightly negative performance.
Okay, great. So now let's take a look at these, the equity asset classes one at a time. And one thing that has changed since last month is that Japanese equities have now moved to be the most attractive of the equity asset classes that we model. So maybe we could start there and you could let us know what the model is picking up in terms of Japanese equities.
Yeah, Japanese equities is one area that for some time we've commented on, both the absolute as well as the relative levels of undervaluation versus the other equity indices that we model. Though for some time that catalyst for reinvestment was absent. Then in early June, we saw the early signs of a catalyst. In particular, it was the steepening of the Japanese yield curve, indicating the potential for future growth prospects, something we had not seen in a long time, and led to a commensurate allocation for client portfolios. By the end of August, though, this alongside two other important factors helped further bolster Japan at the top spot. So first is the continuing compression in corporate credit spreads, which makes borrowing cheaper, as well as rolling over existing debt and the debt service burden cheaper too. This lower cost financing, coupled with our measure of positive investor psychology, helped elevate Japan to this top projection.
All right, that's great. So now let's take a look at emerging market equities, which remained attractive, but not quite as attractive as Japanese equity markets.
Yeah, so emerging market equities were the highest projected asset class in July. And at the end of August now, they share this top spot with Japanese equities. The significant decline in the US dollar versus a basket of international developed currencies in July continued, though to a lesser extent in August, which continues to benefit EM equities since a material portion of emerging market debt is denominated in US dollars. In addition, emerging market equities like Japan continue to benefit from steepening yield curves and tightening corporate credit spreads.
Very good. So now let's turn our attention to US equities. Research is indicating once again that US equity markets are significantly overvalued. I believe the S&P price to sales ratio recently hit a new record all-time high, which I imagine is one reason that US equities are not as attractive as Japan or emerging markets. What are we seeing in the US equity market?
Yeah, so in the absence of these significant levels of overvaluation that we've been discussing for many months now for U.S. equities, we'd see a much higher projection, on par with Japan and emerging market equities. Just looking at the S&P 500 price to sales ratio, which you just alluded to, that feeds into our valuation model, and we can see that as of the end of August, it is at the highest level. And we'd have to go back to a calculated value. We didn't even have data for this back then, but to the summer of 1929, it's the last time you would have seen a price to sales ratio on this level. So from a valuation standpoint, certainly stretched. Economically, though, U.S. equities continue to benefit from Federal Reserve stimulus. We actually convert this stimulus into a shadow rate offset effect onto the prevailing bill yield to get a quantitative measure of their efforts as either being expansionary or contractionary. And needless to say, although I'll say it, this has been beneficial to the US and other equity markets globally. Behaviorally, US equities are exhibiting positive investor psychology as well, but as we mentioned, the overvaluation is taking a haircut on this otherwise positive projection.
Very good. Okay, great. So now, last, what is the situation in Germany?
Yeah, so German equities remain modestly positive. Economically, they continue to benefit from their own monetary and fiscal stimulus efforts, as measured by the steepening yield curve measures that we calculate. They remain somewhat fair valued and behaviorally attractive as well, though risks remain as any changes to these steepening yield curve measures, quite frankly, for any of the equity indices that we're looking at, could signal headwinds to a continued recovery in these regions.
Very good. Okay, now let's switch from stocks to bonds, and maybe just take us through what the model is telling us in terms of both rates and credit.
Sure, yeah. So the entirety of the bond market continues to be heavily influenced by policy intervention from the world's central banks, and in particular the US Federal Reserve. While interest rates continue to hover around all-time lows, August demonstrated in particular the potential for upward movements in yields, that is a decline in price, which highlights the risks to intermediate and longer-term fixed income. As you mentioned, we consider this asset class to be overvalued, as the entire US Treasury yield curve now yields less than the expected rate of inflation. And while the credit markets continue to benefit from narrowing corporate spreads, thanks to the extraordinary Fed intervention, risks of an unwind, that is a widening of spreads, remains. And this would be indicative of a stalled out economic recovery and may signal an impending correction in the equity markets as well, something that would likely impact our outlook on all asset classes.
Right, very good. All right, now let's shift gears once again and now look at the real asset market. That would be both gold and commodities. And why don't we start with gold and see what the model research is indicating in terms of gold as an asset class?
Sure. Yes, still a very positive outlook on gold. We've maintained that for quite some time now. We saw a significant weakening of the US dollar in July, which we noted earlier and last month. This continued again in August, and we also saw a continued decline in real yields, that is nominal yields less expected inflation rate. So both of these factors are helping to just maintain that positive outlook on gold.
And then if we look at commodities, similar story there with the decline in the US dollar.
That's right. Absolutely helping there as well as we enter September. In addition, as we noted, is the case for a number of equity indices. Our commodities outlook is also benefiting from tightening credit spreads, which is indicative of an economic recovery.
All right, great. So now let's wrap it up with short-term fixed income, cash equivalents. What are we seeing there?
Yeah, so this traditionally serves as our dry powder, though given our somewhat positive outlook on equities generally and gold and commodities we've discussed, much of this has been deployed in our client portfolios. Though, as we noted, no shortage of risks remain to this recovery. Today, notwithstanding, we've been experiencing and we may remain vigilant, watching our model output. We stand at the ready to sell these so-called risk-on assets and raise cash levels to avoid the potential for a more significant downturn for our clients.
Very good. All right, great. Thanks for getting us caught up in terms of our outlook for the 8 major asset classes that represent our high-level multi-asset view. And now, as we do each month, I'll ask Eric for his 3 most important takeaways from today's view from the edge. So, Eric, what do you have for us this month?
Sure. Okay. Number 1, Japanese equities joined the ranks of emerging market equities as the most attractive asset classes we model on a risk-adjusted basis as we enter September. 2, gold and commodities continue to benefit from a declining US dollar, as well as negative and declining real interest rates. And 3, just a reminder that the market and the economy are 2 different things. It may seem odd to some that the markets can perform so well while areas of the economy suffer, but overvalued markets can get even more overvalued. The key will be to look for the early warning signs of reversion to more normal levels, while all members of our investment committee are doing, which is what all members of our investment committee are doing continuously.
Yes, very much true, very true. Great. So my takeaway from today is when I think about our allocations across our strategies is that currently we are very diversified, and that is reassuring, particularly on a day like today. So that will do it for Eric and me here at 3 Edge Asset Management. Eric and I will be back in early October with another edition of our monthly View from the Edge video. Meanwhile, Steve Cucchiaro and I will be back at the conclusion of next week with our latest edition of the 3 Edge Weekly Update. As a reminder, all of our videos are available on our YouTube channel, and feel free to subscribe to that channel and also to share these videos with anyone who you think might be interested. And so that will do it. From everyone here at 3 Edge Asset Management, we want to wish you a safe and relaxing Labor Day weekend. Eric, thank you for joining us and providing your valuable insight.
My pleasure. Thank you.
Thank you, and thanks for listening.